Welcome to today's episode of Positively Geared. I'm co-host Alex Augustiniak, and I'm joined again in the studio with Lloyd Edge, host and author of the book Positively Geared. Lloyd, so good to be back, mate.
Alex, good to see you again.
So we've got a guest that I think by now needs no introduction, but we'll introduce him once more. John Lindeman from Lindeman Reports. John, so good to have you back in the studio.
It's a pleasure to be here.
Now, Lloyd, John's episode that we did with him last year was one of our best episodes, wasn't it, in terms of uptake from listeners?
It was. In fact, our Positively Geared podcasts are actually doing really, really well. And John's episode last time was one of the most listened to out of all of them. So that was fantastic. And I think it was really pertinent to have him back and chat again about how the markets are going at the moment.
John, I look at you as a well of information and knowledge, and obviously your reports, for anyone that hasn't had the privilege of reading them, you know, they should jump on the website, which we'll provide again at the end of this podcast, just so that they can get access to that brilliant mind of yours. But we do want to discuss today, so much has happened since we all were last here in the studio. Obviously, we're all wearing masks last time we were in the booth. Well, not literally when we had the microphones to our face, but so much has changed over the past 6 to 12 months. We feel as a country that we've sort of got right on top of COVID, and as a result, we've seen some real buoyant activity in the market. And Lloyd, I know last time we had John in the studio, we actually made some predictions around what we thought the market would do. So how do you both see the change over the last 6 or so months since we last caught up?
Well, I think we made quite a few predictions the last time, and I think we went against what the mainstream media and people in general are doing. I guess people in general are like sheep, and there were some big predictions about big falls in house prices, and I basically went against that and thought that's not going to happen. We outlined the reasons why, and I think it's really good today to discuss where things are now and why they are now. Because even though what we predicted last time is really the opposite now of what a lot of people thought was going to happen, it's actually gone very much the other way. And it'd be good to have a chat today about why those markets are doing what they are.
John, you obviously, for example, I might focus on, the Northern Beaches, or call it Sydney Metropolitan at large if we really push it. Lloyd, you obviously do delve into many other markets, both regional, coastal, sea changes, tree changes, and so on and so forth. But John, you virtually look at every market in the country. Now, what's your view on things since we last caught up in terms of where we were to where we are now? And then afterwards, we can jump in together, the three of us, and maybe have a look into, what are the drivers behind this and what's actually got us to today in terms of, strictly speaking, the Sydney market as an example is incredibly buoyant. There's a lot of FOMO at the moment, both with buyers and sellers, which is interesting. How do you see things, John, since we last caught up?
Well, I guess I'm very lucky because I've got access to our database, which tracks all of the leading indicators and the sales, rental vacancy data, or pretty much all the data that's relevant to the property market for every suburb in Australia. And what I do is I look at the changes in trends. And so when we last met, I could see that although sales were dropping, listings were dropping as well, and therefore it meant that there was no way the market was going to fall in the way that was predicted by some. What we're seeing now, of course, is a lifting in sales and a reduction in listings, showing that the market's actually booming. And that's happening all over Australia. It's not just in Sydney or Melbourne or Brisbane, regional areas, markets all over Australia. And it's being led mostly by owner-occupiers. So I think that's the one big change we've seen, owner-occupiers flooding into the property market.
It's interesting, John, and you raised this point with us before we hit the record button, and it's a bit of a contrast to several years earlier. Obviously, in the last property cycle, there were a lot of investors in the market, and we saw changes to credit policy and APRA getting involved to sort of put a curve on investor lending. Now we're very much in a market where it's driven by owner-occupiers, and it's a different dynamic, isn't it?
It's completely different because people who buy properties as owner-occupiers do so to live in them, and they intend to do that for a long period of time. Whereas when investors buy properties, they're doing it for profit. Obviously, that's why you're in the market as an investor. So you're looking at both good cash flow and growth as well. But I think also what's behind this is the fact that the banks have been reluctant to lend to investors, but not to owner-occupiers. And to give you one example, we run a mentoring program, and one of our students 6 months ago was offered $600,000 pre-approval, and 2 months ago that was $800,000, and they just told me yesterday that they've been approved for $1.1 million. This is from the same lending institution. So that's why people are running out and buying property, and because they can buy at much higher prices, it's causing the market to rise dramatically.
Looking at today versus then, and that's a great anecdote, a buyer that was approved at X amount, last year versus today. Where do we both see this heading in terms of, I sort of look at the economic drivers behind why this has sort of happened. And my view has been in basic terms that obviously during COVID, there was a lot of fear around financial stress on small business, which is the backbone of this country. Obviously, the housing market plays a really big role in us economically as a country also. And I've tended to feel that, this is almost a byproduct of helping us. Obviously when people spend money, that fundamentally is what makes an economy function. Obviously, it's a bit more complicated than that. But I think, with people investing into housing, spending money, I know Westpac released a report before Christmas last year, which was basically they expected more Australians than ever to make big household consumer purchase items last year or purchase property. And that's sort of what's happened.
Alex, so I think a couple of things that are really driving the markets on top of that is really the really low interest rates that are just basically being predicted to be low for the next 3 years. And I think that's given a lot of confidence to people. I personally don't think they really should be like that for that long, because I actually think that the RBA should look at increasing those rates at some stage to help even out what's happening in the markets at the moment. I think the other thing that might be happening in the current climate is the fact that people haven't been able to go overseas. They haven't been spending money on overseas holidays, and they've just got a little bit more cash available. And as they've, more money's been coming back into the household, people are getting off JobKeeper and all that kind of stuff. People are getting more confidence. They're spending money more at home. With borders being closed, they generally didn't even spend a lot on interstate holidays. It was more local. And I just think people have got more money to invest. And that's one of the things that's really helped people put more money into the local markets, into the property markets. And then, of course, the last thing the government ever really wants is any kind of a housing crash. So I think the banks making lending a lot easier is really helping things move along as well.
Guys, we've had in very recent times the benefit of being able to look back and reflect on the sort of the last decade in property. There's been a lot of activity over that period of time, more so than in other property cycles, at least in my view. And one of the big things was the Royal Commission on Banking in 2018. And what we saw as a result of that was just how quickly, with government intervention, things can be slowed down in terms of credit policy. And, that's obviously, as we've just identified, and you've mentioned, Lloyd, one of the big drivers behind the current market conditions. With the benefit of experiencing that, and the current state of the market. John, we might start with you. What's your view for the next 3 to 6 to 12 months? I know obviously you didn't bring your crystal ball with you today, but I do believe that, past performance generally can be an indicator of future performance.
One of the things that's happened in the last 6 months that is probably fairly unique is that the Reserve Bank said it wouldn't increase interest rates, as you mentioned, Lloyd, for 3 years. And one of the reasons they did that is because the government has been lending itself billions of dollars. That money gets washed through the banks, so the banks have got heaps of money to lend at very low rates. But there's a limit to that. And another thing that's happened is that the affordability limit that banks place when you go to a bank and you want to borrow money, they were assessing you at 7 or 8% to say, can you afford to make repayments at that rate? But they've been dropping that right back. And that means that a lot more people can borrow a lot more, even if they haven't got any more income, because they're being assessed at 3 or 4%. So I think it's got a limited time to run. I really do think this market will slow down. When you see properties at auction where the offer is, or, where the estimated price is around 1.1 million and then it goes for 1.4 or 1.5, that can't last very much longer. And I think we'll reach that new affordability limit and the market will tend to slow down.
Just on that, John and Alex, there's been a bit of talk around again. I've read a few articles with people sort of complaining about agents underquoting on properties and things, but I actually don't think that's really the issue. I think more the issue, and I think, Alex, you might be able to speak a bit on this too, but I think more the issue is that agents don't really see what a property can actually sell for because the prices keep increasing every week at the moment. So, they've got a pretty tough time working out what the price guide will be, and the comparables that properties might have sold for a month ago mean nothing for now. So you can actually put a price guide of $1 million on a property, and that doesn't mean it's going to go for anything like they think, and going for 1.4 or something like that on a price guide of $1 million is just the fact that that's how buoyant the markets are at the moment.
Totally, Lloyd. And I mean, if you guys were to walk through any of my open homes later today, it is a Wednesday, there's a lot of buyers out there at the moment that are saying, Alex, what's it going to sell for? And, that's, to me, that's a bit like trying to pick the winning lottery numbers at the moment. But there really is, in my view, from an agent's perspective, there's not an exact science behind a lot of prices we're seeing at the moment. There's also, interestingly, when you look at it from a geographical perspective, for example, we're recording here on the Northern Beaches, we're getting a lot of interest from the eastern suburbs, the lower North Shore, markets where the average sale price is significantly higher in most areas. So when that money comes into, parts of markets within the beaches, there's obviously buyers that have more money to spend. And as a result, I think that's what's really driving a lot of prices, I suppose, at a local level. But I mean, you're quite right, Lloyd. I think even in terms of price guides, I mean, every agent operates differently. For me, I don't like to put a price guide on a property straight away when going to market. I'd rather put an auction guide, assuming that's the method of sale. And then I like to position the price guide in line with where feedback is from the market. But if you're a listener today that is out looking to purchase, generally a price guide, at least in my view and how I operate, would be a reflection of initial to early interest in the property. So I think a lot of buyers have over the last few years become accustomed to knowing that wherever the property is positioned in terms of a guide, it could sell 10 to 15% above that guide.
Yeah, I think just what's happening at the moment is that they often sell for more than that 10% above that guide. And that's just an indication of where things are at the moment. But as we've been discussing this morning, that's not going to last for too much longer, I think.
Absolutely. And that's why I say, there's really no exact science behind. You could have one geographical market where you might see 3 or 4 really strong, I'd call them freak results, and then the other results are more indicative of a normal, stable market. So you're quite right. And I think, if I was sitting down today and you guys are about to sell your home and you're saying, look, Alex, we saw that this property is guiding for this price. There's this one around the corner from us, the Joneses, they're up the road. They've got this got price guide on their property. Where does our property sit? I always bring it back to sales data. Let's look at actually what's transacted, because that's a better indication of the market's determination of value than a price guide, because, a price guide can change one day or be far off the mark from the sale price. John, Lloyd and I were discussing, it's a bit of a buyer frenzy at the moment, but it's also a bit of a seller frenzy at the moment, because naturally, in these market conditions, very quickly, sellers cotton on that the market conditions are very strong. They've probably got 1,000 agents calling them, telling them to get their property on the market yesterday. But also a lot of buyers at the moment are, losing their mind, so to speak. There's not much rationality, in a lot of daily conversations I have. It's, Alex, we need to find something. We need something today. We don't want to wait for the market to get away from us again. But in terms of, you've obviously mentioned, John, that you see the market softening in the next, probably, let's say, short to medium term. I share that view. And I think it's once again coming back to the economical drivers behind what's created this market and what can, quickly change this market. What do you make of the current buyer frenzy and seller frenzy, and what's some advice you could impart to people listening today to help them make better decisions?
I think what's going on at the moment is, as you mentioned, it's a fear, both from buyers and sellers, they're going to miss out. And that is also leading to the other effect that you mentioned, which is where if people can't buy in one area, they start to look at another, and what we call the ripple effect. That also indicates to me that there's a limit to what can happen, because once that ripple effect starts happening, it has an end to it, and then that's something which we're heading towards. But in general, what's driving it is simply the bank's willingness to lend people money. So if you can get a loan for $1.5 million, and I've heard of first-time buyers getting loans of up to $1.1 million, which is quite unheard of a year ago. But that's what's happening. So that's what they're buying up to. But there'll be a limit to that. And I think, as I said, the whole market will start to slow down. A lot of commentators are suggesting that maybe investors will get back into the market, and that'll be the next boom when investors start going mad and buying properties as they were back in 2016, 17. And we had something like 40% of properties being bought were by investors. At the moment, it's around 23%, so that's too low. APRA has said they're not going to intervene in the market in terms of trying to control buyer interest or buyer ability unless investors get up to over 30% again. So we've got a sort of room to move. But I don't think that investors are really interested in this market at the moment because rental yields are far too low. If you look at Sydney, 2.4% is the average yield. It's way too low for investors to comfortably get any sort of return. So they're not going to really get into this market, not the main capital city markets, while yields are like that. So I think it'll just gradually slow down.
And just on that note, John, we buy for quite a lot of investor clients, but most of those purchases are actually outside of Sydney, where the clients can get higher rental yields, but it's still a big challenge buying in this current climate. I mean, we've been buying in regional towns where we've still got properties where there's been 25 or 30 offers on one property in a regional town. So even those regional markets are really booming at the moment. But the trick that we've been finding there, because it still comes down to, buying the right property and making sure you're not paying too much. And the only way an investor can really get ahead is getting something that's off market or as soon as it is listed before everyone else jumps on it. And that just comes down to having those relationships with agents, because once it's been listed, there's just a frenzy of buyers still going for it.
Lloyd, we talk about when's the right time to buy. And, we all tend to agree that it was, if not yesterday or 10 years ago, it's today. What are some of the things, and John, possibly you can touch on this too, that if you're listening to this podcast today and you are a buyer in the market, you're continuing to get priced out of property and you do have a bit of fear of missing out, but you're also now, with the knowledge we've imparted over the last 20 or so minutes, know that, you don't have to get in right this second. Let's keep our feet on the ground and have an intelligent approach. How would you suggest people approach buying in this current market?
Well, I think you've got to have realistic expectations as to what the market's doing, and that means maybe buying a property that's not quite, the property you wanted, but it's one you can afford. So I'd say go in there, realise what your buy price limit is, and then look for properties that are currently, the guide is well below that, and you've got a chance of getting a property, because most first home buyers will sell after about 4 years anyway, and they'll upgrade to a better property. And a lot of that's occurring right now, where people are upgrading from their first home to a better second home. So I'd say just buy a property. Don't wait for prices to go down, because they won't, and they certainly might slow down, but by that time you'll have been priced out of even the area you want to live in. So I'd say just buy a property that's reasonably okay in a reasonable area, and then you can upgrade in 4 or 5 years' time.
And Lloyd, obviously you're our star buyer's agent within this three-way conversation.
Within this studio.
Yeah. What's your view on the approach? I mean, you obviously deal with a lot of different clients. You're in the trenches every day, so to speak, whether it's owner-occupiers, investors. Obviously, you give really great advice to your customers and quite more often than not, I would say, suggest they look further afield or outside of areas that they're currently looking at. But how do you handle this situation?
Yeah, so, and as I have written about in Positively Geared, about strategy, this is a strategy as well. So it's a purchase strategy. And as John said, part of that strategy, and I do use the term purchase strategy when I'm talking with my clients, because it's about then understanding the markets, what the markets are currently doing, and what you can actually get for your money to start with. So if you've got $1 million budget, you certainly don't go and start looking at properties that have a guide price of $1 million or even a guide price of $900,000. We scale that right back and say, okay, guide price of $700,000, not quite the property you had in mind, but that's more likely to sell closer to your budget, and it's more realistic that way. So it's about managing expectations. So, and that's more when it comes down to the owner-occupied type properties. And same thing if you're buying more expensive properties, in the Sydney markets, it's still the same thing. If you're buying if you've got a $2.5 million budget, then you need to be realistic about what you can get for that. And you might need to be looking at properties that are, might only have a guide price of around $2 million, just to give yourself a bit of a chance. When it comes to investments, then definitely, the world's your oyster more to the extent that you don't need to be buying in Sydney or Melbourne having those low yields. There's some good, strong regional markets. Go for higher cash flow and look for some alternatives with the investment as well. So, if we can get a good property in a good, strong location, and there's something unique about that block that you can do something with, maybe add a granny flat to it to turn it into a dual income. Maybe it has development potential in the future. Things like that, that'll just a little bit unique. So you'll get a bit of growth, but you can add some value to it and things like that. That's what we need to look at from that perspective. And then again, it also comes back to the purchase strategy in terms of, okay, how much is this property going to go for? And then trying to get some properties before they even hit the market.
John, I'm quite intrigued by your observation that there's very few investors in the market compared to, several years ago. We've obviously discussed the reason why that is. Is there, in your view, an advantage being an investor in this market in terms of obviously, the competition's there regardless. There's no set rule as to this property's only opened up for owner-occupiers or investors. But what are some of the advantages that you might have investing in this sort of market?
Well, I think Lloyd has picked up on the first one, and that is that you're not going to live in the property, so you can pretty much buy anywhere in Australia. And there are some great opportunities for investors right now and some coming forward. The ones that are coming forward, before the pandemic, for example, 40% of our population growth was from locals, homegrown people leaving home, people being born, that sort of thing. So we're still getting a lot of younger people leaving home, and they're nearly all renters. So the thing about renters is, and especially when they're first-time renters, they're not going to be looking at $1.7 million homes in, Gladesville or something like that to rent. They're going to be looking at inner urban areas, unit markets, those areas that have suffered most over the last year. They're going to be the areas that will deliver the highest rental yield, because that's where those young people will want to rent. And when we've looked at our database and we've looked at the state of the unit market in Sydney, in particular the inner urban market, it's in a state of balance. In other words, the rental vacancies have fallen to the point where rents are likely to start going up. So there's some great opportunities to buy at a good price in a market that isn't being overwhelmed by owner-occupiers, where you can get a property and it'll start to deliver really good yield. The other thing that's happened too, and it's what I call how to profit from a pandemic. I mean, that sounds pretty bizarre.
Like a book.
But there are certain things that have happened in the market which were caused by the pandemic, which are really going to benefit investors. And that is in particular in Queensland and WA, where the governments, both recently re-elected, have introduced strong border control policies and also to favour jobs for locals. So in WA, for example, all the mining jobs go to people who live in WA. You can't fly in and out anywhere else anymore. In Queensland, it's even stronger. What the government there has done has said, and there are leaders in job creation from construction, mining and infrastructure projects, they're saying you have to actually live in the city where the project is being run. And so we're seeing that these big cities like Rockhampton, Mackay, Gladstone, the rent demand is escalating dramatically as people move into these towns so they can get the work. And that means that, like in Rockhampton, for example, the rental yield is around 7% in most areas. You can buy a property there for $300,000 to $400,000, and it's generating, positive cash flow from day one. So the opportunities are out there in these areas, and they're regional areas, as Lloyd said. Them, you mightn't want to live there, but that's not the point. What you're doing it for is to get positive cash flow from day one, and you're getting good growth potential as well.
I think, what I've picked up on, and I hope that our audience of listeners has also picked up on, which is pandemic or no pandemic, the principles to investing very much have not changed. And Lloyd, obviously you can build on what John's just said, but it's no matter what's going on in the world, it's looking for those right opportunities.
Yeah, absolutely. Yes. And the fundamentals are all still the same. And I guess moving on from what we've just been discussing, one of the things that I did allude to a lot last year was that, I felt that there was going to be a lot of people moving away from the cities to the outer suburbs and to regional markets as a result of the pandemic. People sort of moving to somewhere larger to live because they needed home offices and things like that. And that has resulted in these regional markets becoming a lot more popular. And there are people that are moving to these markets as a bit of a sea change or a tree change. That's also resulted then in some investors going to these markets as well. But that's really pushing these prices up, and there's been a bit of a newfound life. But at the end of the day, the fundamentals are still the same, and just making sure that you've got good economic drivers in the markets that you're buying in, and you understand why you're buying the investment. So if you're buying the investment because you're looking for good cash flow, or if you're expecting to get some growth, or you're looking to add some value, all these are different strategies. So you need to actually understand how that investment is actually going to work for you.
Absolutely, Lloyd. And I think, as you touched on, probably the biggest trend we've seen as a result of COVID is the lifestyle purchase. We've got a lot of people, as you rightfully just said, moving out of the major metropolitan markets, and they're looking a bit further afield. All of a sudden, 1 hour drive up the coast from Sydney doesn't sound too bad at all.
Oh, absolutely, yeah. And I think, 1 hour drive up the coast from Sydney that's kind of been on the agenda for years for people. It's been
very true.
Quite a while ago since people sort of moving to the Central Coast and even Newcastle as a bit of a sea change, and people were sort of moving up there because it was more affordable, and then still working in Sydney and commuting to Sydney, and that actually pushed up the prices in the Central Coast a few years ago. Now what's happening is the Central Coast is booming again, very hot market, but now people are moving there and they can work from there because more people are working from home and things. Again, I don't think that is necessarily a long-term fix, because I think businesses still are going to require people to come back to their offices. I think people's dreams of just living the lazy lifestyle at home and working in their PJs and things like that may not be, everybody's solution for every business. But certainly that's been a bit of what's been happening during the pandemic.
Guys, if we can just for a moment go back to the whole concept of FOMO, which we're seeing out there at the moment, particularly with buyers. I mean, I'm speaking to buyers almost on a daily basis, and the general consensus or feeling seems to be that if they don't buy today, the world's going to end. And obviously we do advocate, we think now is always a great time to buy. If you're going to start your investment journey, why not do it today? Don't wait 5 or 10 years. How do you both recommend that people do deal with FOMO though? Because FOMO itself can be a bad thing if obviously that moves you towards making irrational or poor decisions. And Lloyd, we might start with you on that front, because I know you spend a lot of time advising your clients on this very matter.
Yeah, absolutely, Alex. I think FOMO is a very real thing in the current markets. And I guess one of the things I always say to people is that you never make money by waiting. So when people say I might wait for 6 months or 12 months to see what happens, it's generally not a strategy that I suggest. So again, it comes down to the purchase strategy and finding the right property in the right market. So as an investor, it does come down to where you're going to buy. That's going to suit your property, that suit your strategy, that you can get for the right price, and maybe getting something off market that we've talked about. As an owner-occupier, our job in terms of finding primary residence for people is making sure that we can find something that closely matches our clients' criteria and also not allowing them to pay too much. So that becomes a bit of a challenge, but we're not going to just buy anything just for the sake of them getting into something. So we do try really hard to prevent the FOMO, but part of that is also the education. So, for example, I had a client the other day who, was desperate to buy a primary residence. They had approved for $1 million and just thought, I really just need to buy a home. I just need to spend my money. We had a good strategy session. And at the end of that, we decided that she's actually going to go and buy an investment outside of Sydney, spend about $600,000 on that. Have a really good rental yield, and she'd still have some borrowing capacity left to be able to move on to perhaps a second investment as well. And not worrying about just jumping into buying a home, because it's not the right time for her to jump in just to buy a home in Sydney just for the sake of it, because she already had somewhere nice to live. So it's about managing people's expectations and that FOMO.
And John, from your perspective, obviously looking at a lot of numbers and data every day, do you have any, I mean, you've obviously, I know that you've studied the market since almost the beginning of time, at least as Australia as a country. And, part of doing that, obviously you'd start to see clear trends, decade in, decade out. Is there anything that you can impart, particularly from a numbers perspective, for people that are faced with that FOMO at the moment?
I think, Alex, there are a number of things that come to mind. And the first one is don't wait for prices to come down, because they might a little bit, but then they'll go up again. And that's the history of our property market, has always shown that it takes a really, really severe depression for a long period of time to cause any sort of significant fall in prices. So that's the first thing. It's going to keep going up. But the other thing is maybe, and as Lloyd said, maybe you shouldn't be looking at buying a property to live in, because it's going to cost you a lot of money, even with the incentives and waivers on stamp duty and so on. Owning a property costs you money, and selling a property costs you money. Whereas if you buy an investment property, you've got all the costs of buying and selling are covered as tax deductions, the costs of holding a property, and you've got the rent return as well. And you can buy a property as an investment that will deliver positive cash flow from day one. I've given some examples of areas where you can do that, and there'll soon be many more of those areas around Australia. So don't just do nothing, but don't think you have to buy a property to live in straight away. And if you really do need that property to live in, then I'd say, well, then go for something, as Lloyd said, which is where the guide is a lot lower than what you expect, because it'll probably sell for what you can afford.
I really think this also comes back to what your goals are and understanding that, because we often talk a lot about rent vesting, and it just may be the case that you just don't need a property to live in, that to buy a property to live in, that is, where you could just be renting where you want to live, and you could then live on Bondi Beach or the Northern Beaches or wherever it is you'd like to live, and just buy affordable investment properties and just build up a bit of a nest egg for yourself there, and maybe later on, when you've got a little bit more money and things are a bit more stable in the property market, you might look at buying a home then. But it's not always the case that you need to have a big home mortgage, because there's a lot of disadvantages with that as well. Whereas if you've got an investment properties, it's all tax deductible and stuff like that as well. So there's advantages there, and I think having a real understanding of what it is you really want to achieve over the long run will benefit you as well when making that decision.
I think just to build on two great answers there too. I mean, as a listener, I encounter on a daily basis a lot of people that their expectations from the market don't quite reflect their budget, or more appropriately, the goals they're trying to achieve don't necessarily reflect what they're currently out there looking to do. And I think, if you're a buyer in this market, an investor, an owner-occupier, whatever walk of life you come from, fundamentally, Lloyd, as you always say, having a strategy for building wealth through properties is number one, but also having a paradigm shift around, okay, well, if the bank's approved you for 1 mil and, you probably want to be looking at properties from 8 to 9 and leave a bit of a buffer, particularly in a market like this when you can possibly spend a bit more than you want to. Obviously, you don't want to spend every last dollar the bank's prepared to give you. You've got to be realistic about what you're looking for. You can't expect in your first or second purchase to necessarily get everything you've ever dreamed from in a home. So, there's a lot of people I've been speaking to, and they're basically saying, well, look, Alex, we really want, the ensuite, we want the his and her basins, we want the double lock-up garage, but the budget just doesn't quite reflect that. So I think it's really important to work on strategy over a longer period of time, and that, obviously will help get you closer to your destination sooner than later. Guys, moving forward, it's been a really great conversation so far. Something that we all hear on a daily basis is, the property bubble, or when's the bubble going to burst? And John, you made a really interesting point about that before we went on air. But I think fundamentally what people mean by when the bubble's going to burst is when are these market conditions going to essentially soften, and when are things going to go back to a more, the term we use, the correct term is stabilize. But John, you mentioned a really good point about what a property bubble is. Can you shed that light with people listening today?
Yeah, when booms start, booms and bubbles, if you like, look very much the same. Prices are going up, demand's rising, there are more people trying to buy than sell. And this goes on, and with a bubble, of course, it bursts and then prices start to come down, sometimes very dramatically. So people say, well, what's the difference? How can you tell? And you can tell by the type of buyers that are in the market. At the moment, it's nearly all owner-occupiers. These are people who are going to buy a house to live in or a unit to live in. They'll be there for a long time. So if the market stabilises, which I think it will, they'll just simply keep living in those properties. They won't sell unless they really, really have to, which is highly unlikely. However, when you've got a bubble, that's when most of the buyers are investors, and that's not happening right now. But when you have a lot of investors buying properties, the difference is they don't actually live in the properties. They can buy a property as an investment and somebody else rents it. And then if the investor wants to, they just simply put it on the market and sell it. So it's much easier to buy and sell properties as an investor than if you're actually living in those properties. So that means that if conditions suddenly turn bad, investors will all decide it's time to sell their properties. And if they all do that at the same time, that market can collapse. So we've seen that in the mining towns in the past, during the mining boom years. When the mining booms ended, prices in towns like Moranbah and Claremont and so on collapsed. Went from $1 million down to $100,000 in just a few years. And the reason for that was because they were all investor owned and there was no more rent demand. So that's the difference. What we've got is a owner-occupier led boom, and that's why it won't burst. It'll just simply stabilise and slow down.
I still own my property in Blackwater.
What did you buy that for, Lloyd?
I bought it for about $260.
Oh, you did well.
But it was renting for about $800 a week. But when I wrote about it in my book, actually, it's a reminder of what not to do. But when the mining boom ended, it went from $800 a week to about $180 a week overnight.
Yeah, there's a lot of stories like that, a lot worse too. And I think the lesson from that is that always be wary of markets where investors are doing most of the buying, and we're not in that sort of market right now.
And I think, the main lesson from that for me is never buy in a one-horse town. And for me, I got on the bandwagon of, this is very, very early in my investing days, of course, but getting into somewhere where I thought, really attractive rental yields, lots of growth happening in the markets. I thought, I want to a winner here. And of course, then I started to become well educated about investing and all that kind of stuff. But yeah, there's a lot of people that did quite bad with that, because a lot of people were quite greedy and bought 10 of those type of properties in the same town, particularly in some of those Western Australian towns like Port Hedland. And people unfortunately went bankrupt with those sort of strategies. So got to be very careful of that sort of thing.
I mean, yeah, you would have felt like a rock star with those kind of yields. They're hard to come by. But obviously, and it's a good story to share, Lloyd, once again, because, it goes to show that no matter how experienced you are, everyone at times in their property journey will possibly make, bad decisions or just uneducated decisions. And obviously that was something that you did very early on. And it's, I guess, allowed you to get to this point today where you can now impart this knowledge onto our listener base so that they don't have to do the same things. I just want to spend a little bit more time. Obviously, John, how you explained a property bubble was a really great definition, and I don't think that most people typically associate it with that. But let's talk about just what are some of the other drivers that could possibly make a market soften. So, for example, obviously credit policy, if the government, as they did during the Royal Commission, makes it harder for certain buyers to enter the market, or generally, credit becomes harder to receive, that overnight can have a big bearing on the market. I guess by the same token, the media can play a huge role in talking up or playing down the market. Is there anything else, John, that comes to mind that can possibly influence market conditions quite quickly?
Well, there are three that I always call the three Ps, and that is people, prices, and places. And the first one is people. So if people are wanting to live in a certain area, they're creating demand for properties to buy or rent. So if that changes, and COVID did change that because our international borders were shut and suddenly the inner urban unit markets in Melbourne, Sydney and Brisbane collapsed because nobody was coming in to rent those units. So that's the first thing that can have a big effect, is if there's a change to the movement of population in and around Australia. The second thing is the prices or finance, the cost of finance, and as you mentioned, the availability of credit. So if the banks suddenly decide to limit finance, or if interest rates start going up, then you've got another big problem, and that could cause prices to soften and even fall. The third one is places, and by that I mean simply overdevelopment. So if you get too much development in a certain area, and that always tends to happen in unit markets, you find that when there's more supply than demand, prices can fall as well. And sometimes you get all of those occurring at the same time in the same area. And when that happens, of course, you've got a market crash. But it's highly unlikely that those will occur in any of the big markets in Australia.
Guys, we've had a really good, I think, productive podcast today. We've covered off on a lot of interesting topics that I've got no doubt a lot of people out there will be really keen to soak up the information we've provided them with. Lloyd, I know that we spoke about your market predictions, when we last all caught up in the booth last year. A lot of those or all of those were, they came true and they were right. Do you have any view on where you see the market heading over the next 3 to 6, 12 months?
Well, I think I agree with what John is saying, that this is not sustainable for everyone. And you're pretty much saying the same thing too, Alex, before you came on air. But I think, give it 3 to 6 months and we're going to see a bit of a plateau in the markets. But I don't think we're going to see any significant fall or anything. I think we're going to see a bit of a stabilization, I guess in the prices that we're seeing at the moment. But it is very much driven by home buyers at the moment. I think there'll probably be more investors that come into the markets later in the year and into next year. So I think overall we're going to see some continued house price growth, but I think that'll actually stabilize for a while, and then the investor type stuff will take over coming into next year. So there's not going to be much of a lapse, so to speak. So people are sort of thinking, I might just wait for 12 months and then wait for prices to fall and then jump in. I still don't think that's the best strategy, because I don't think prices are really going to come back, because then it's just going to be another thing that then drives that market forward. However, so I think people just need to really look at their goals, have a strategy in place, and then look at what they can buy at the moment in the current markets.
Really good points, Lloyd. And I think, the key word there, stabilization. I mean, a market by definition stabilizing doesn't mean that it's going to contract by 20%. I mean, that we'd all, I think, be very shocked if that were to happen, particularly in, the main markets in Sydney and Melbourne. John, do you have anything to add on that?
Well, only just as Lloyd said, it's very important to have the right strategy in place. So whether you want to buy a property to live in or want to as an investment, make those decisions carefully. As far as the market goes, I think it's going to stabilise. I think more investors will come in particular in the unit areas. And then the big question is what will happen when our international borders reopen, because I think that could fundamentally change the markets again in a big way. But that at this stage, we don't know when that'll happen. So stay tuned and we'll find out more in the future.
Yeah, absolutely, John. And I think too, the general... Because, I mean, I'm of the view also that the market will definitely stabilise in the next 3 to 6 months or so, for more or less all the reasons we've discussed, economical factors, so on and so forth. But the other thing that, I am reminding people of on a daily basis is that don't underestimate if COVID's taught us anything, don't underestimate how quickly things can change overnight. Obviously, back in March last year, 12 months ago now, which seems a bit scary to say, we were locked down virtually within 48 hours or 24 hours notice. And, we saw a dramatic shift in the climate very quickly for a period of time. Now, obviously, we've come out of that. But I guess, as you said, John, as borders start to open, we're very lucky that we're an island and basically we can run our country on almost a zero policy, a zero COVID sort of model where, our country is basically trying to not have COVID in the country. Now, a lot of other parts of the world, you look at the US, you look at Europe, they have to work on a baseline sort of policy in the sense that they're obviously connected to other countries. So they're trying to control COVID as opposed to just completely obliterate it. Obviously with vaccinations, that the end goal's for COVID not to be present anywhere, but there's no guarantees if and when that'll happen. So as you quite rightfully say, as we do work back towards opening up our borders, that could possibly have a bearing on what happens in the next 12 to 24 months. But I think for now, we can only control what we can. And while market conditions are good and there's investment opportunities out there, if you're listening today and you're sitting on the fence, I think now's as good a time as ever to make that next decision.
Always good time to buy or invest if you can. Just got to have the right strategy. But John, like I said at the start, people love listening to you, reading your reports, and when you came on last time, you were very well received. So thanks very much for coming on again.
It's been an absolute pleasure.
Thanks so much, John. We've really enjoyed our time with you.